Well, I think not much should come today. So 25 basis points looks like a done deal. It remains to be seen whether it's for the three policy rates or not. Otherwise, I guess the ECB will leave the door open for more in September. We will get much more data until the September meeting in terms of inflation, 2 more readings, in terms of wage development, labor market, money growth, and so on. So enough data for the ECB to remain elusive about September.
But still the system, despite the record pace of tightening, the system is still flooded with liquidity. Yeah. So are they planning on doing something about this?
I think the ECB will have to do on this. The ECB will not be done in terms of normalizing its monetary policy once interest rates peak is reached. As you say, it's about the balance sheet. How quick, how far you reduced it in terms of QT, in terms of excess reserves by banks, which are still plentiful right now, and at odds with the level of interest rates. And on the asset side, the question is maybe more on the APP, so the older QE portfolio, than on the PEP, because the APP was designed to revive inflation. I would say mission accomplished. And the question is really for the ECB, maybe from September, but in any case before the end of the year, whether the ECB can let the APP running off simply by having stopped reinvestment. That's the question.
Yeah, do you think there will be, or there might be a majority in the making to shrink the balance sheet faster after the summer break?
I think it will be a topic of discussion for the Governing Council. As said, the question is really about the design of the APP, not about the PEP. You can argue you can still reinvest under the PEP, the QE pandemic program, as long as the the domestic economy has not recovered in full from the pandemic. That's okay. But the APP was there to revive inflation. Inflation is almost 3 times above the target. If the ECB says that we will overshoot the target until 2025, there is a question of credibility in this instrument.
Let's talk a bit about the negative side effects of that record pace of tightening, because we've seen the PMIs coming in lower than expected, the German IFO coming in lower than expected. So do you think the economy is headed for like a hard landing?
It's not excluded. So far, the economy is still resilient because we have still some tailwinds from the COVID recovery in terms of tourism demand and the labor market, for sure. But we see that monetary policy tightening is working, and the transmission might be swifter and stronger than in the past, at least through the banking channel. We see the credit impulse is as negative as it was in 2009 or 2012, so not need to remind what was the economic context on these years. The saving rate is going up. We have a massive shift from sight deposit to term deposit. Yes, in other words, monetary policy tightening works fast, and there is a risk of hard landing of the European economy, especially at the turn to next year.